$10,000 in savings, $50 in interest after a full year. You're doing everything right, saving every month, staying disciplined, so why aren't you getting richer? Because saving alone rarely builds real wealth. You move $100 here, $200 there, you feel responsible, disciplined. Then you open your banking app and realize your money is barely moving. Meanwhile, everyone talks about stocks, index funds, and compound growth, and you wonder, am I doing this wrong? The gap isn't between savers and spenders. It's between people who save and people who invest. In this video, you'll get the exact step-by-step path to move from saving to investing without feeling overwhelmed or risking your financial security. Saving money alone will almost never make you wealthy. That doesn't mean saving is wrong. It's the first stage, not the final goal. Savings protect your money. Investments grow your money. Those are two completely different jobs, and confusing them is how people stay stuck for years. Take $10,000. Leave it in a savings account earning about 1% for 20 years, and you end up with roughly $12,200. Invest that same $10,000 at a historical market average of about 10% per year, and you end up with roughly $67,000. Same starting point, completely different outcome. That's compounding, and it's why the biggest wealth gap isn't about who saves the most. It's about who starts investing. But most people never make that transition. Not because the math is hard, because saving feels safe and investing feels risky. Your savings account doesn't drop 5% on a random Tuesday. Investments do. That emotional swing keeps people stuck indefinitely. And if you're thinking, I don't want to lose my savings, that's completely fair. You shouldn't gamble your safety net. That's exactly why this transition happens in stages, not all at once. You don't have to go all in. You build the foundation first, then let a portion of your money work harder over time. Step 1. Build a real emergency fund. Before you invest a single dollar, save 3 to 6 months of living expenses in cash. This money stays in savings, not for investing, not for opportunities, but for when life hits. Job loss, medical bills, surprise repairs. The number one reason people panic sell investments is needing the money too soon. An emergency fund protects your investments from your own life, and it gives you the confidence to stay invested when markets get rough. Step 2. Separate saving from investing mentally. 2 buckets. Bucket 1. Safety money, it doesn't move. Bucket 2. Growth money, it's allowed to fluctuate because its job is to grow over time. That mental split alone cuts a lot of the anxiety. Step 3 is where most people finally start, and it's simpler than you think. Step 3. Start investing small. You don't need thousands to begin. Many brokerages let you start with $50 or $100. The goal at first isn't big returns. It's building the habit because habits matter more than timing. Step 4. Keep it simple. Skip day trading, options, and speculation. Start with index funds. They track the broad stock market, so instead of betting on one company, you're invested in hundreds at once. That means diversification, lower risk than picking individual stocks, and long-term growth without needing to be an expert. The simplest approach often beats the complicated one. Boring works. The most powerful strategy isn't exciting. It's consistent investing, putting the same amount in every month, whether the market is up or down. Put $300 a month into the market. At an average 8% return over 25 years, you end up with roughly $285,000. You only contributed $90,000. The other $195,000 is growth. That's compounding working for you. Investing feels uncomfortable at first. Markets drop. Headlines get dramatic. People panic and sell at the worst time. Discipline is what separates long-term investors from gamblers. When markets fall, consistent investing buys more shares at lower prices, and that often leads to stronger returns when things recover. Think in decades, not days. Here's the full path. 1. 3 to 6 months of emergency cash. 2. Safety money and growth money in separate buckets. 3. Start small and invest consistently.